Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We have right now the perfect guest, given the uncertainties out there, the unknown unknowns and selected and movable known knowns. Edward Yardeni joins us after decades of work with C.J. Lawrence, parchment out of Yale University, and his own Yardeni Research, and he's been absolutely brilliant. Kudos as well to Ralph Ancampora for calling the October low, and I think it was 2024. Ed Yardeni, thank you so much for joining Bloomberg.
Thank you.
This morning. Ed, at the bottom, you go contrarian of your note yesterday, and I want to paint this. I said to one of the interns, they're junior analysts. Oh, okay. They're not interns anymore. Right. Yardeni doesn't call them interns. They're junior analysts. And Ed, I talked to a junior analyst and I tried to explain how odd this uncertainty is around presidential whim. How do you invest for the long term given the buffeting of Trump tweets?
Well, I think you have to tune it out. It's become more noise than signal. The news changes on a daily basis, and I think the market has figured that out. We had Liberation Day on April 2nd. It was postponed on April 9th until July 9th, and now that's been postponed until August 1st. And the market reacted badly to that news yesterday, but not that badly, all things considered. And it's not down much today because everybody's talking about this is the art of the deal. This is the way negotiations go when Trump is in charge.
I will not mince words, folks. A subscription to Yardeni Research is worth its weight in gold, not because of what he tells you to do, but what he tells you not to do, which is to go to cash in market time. Here's the final paragraph written yesterday. We are going to stick with our contrarian position and bet that the dollar will rebound. I just have to stop it there. Talk about contrarian, Ed Yardeni. You look at a dollar rebound, and do you look for a healthy earnings season?
Well, I'm not sure I know of anybody who's bullish on the dollar. I think everybody's not just neutral, but just outright bearish. It's as though the dollar is about to be replaced as a reserve currency by the euro and by the yuan and the yen. And I just don't buy any of that. I think that there's been kind of a reaction to Trump's haranguing of the Fed, particularly Fed Chair Jerome Powell. I mean, that's clearly weighed on the dollar, as has the trade turmoil. But as we've seen in recent months, Trump is negotiating. There's a lot of bluster and bullying going on there. That's the nature of deal making, particularly in New York City real estate negotiations, which is where his background is. So I think the market's kind of getting used to it, and I think that people are going to realize that there's not that much positive things going on in Europe, other than maybe more defense spending, and the Japanese economy doesn't look all that wonderful. Meanwhile, the U.S. economy is resilient. We've got a huge capital market, so I'd be bullish on the dollar here. And on earnings, I think it's a layup. The estimates for the second quarter have been revised down to such an extent. I think they're only expecting a 3% increase. And just like the first quarter, I think we're going to get a big upside surprise.
I see you've got your research assistant in the background there, Ed, coming into the picture. We appreciate that. That gives us confidence. Hey, Ed, I mean, Bloomberg Economics is out with some research today saying they think, at the end of the day, tariffs are going to probably level out somewhere around 15.5%, up from about 2%, 2.3% today. Yeah. That's got to have a negative impact on global economies. How do you price that in?
Well, it's interesting. Global stock markets are basically around the world at an all-time record high. The MSCI for the world is at an all-time record high. It's pretty impressive, and stock investors obviously believe that this tariff war isn't going to last very long. I don't think it will last very long because the administration has to recognize, they do recognize that the midterm elections are coming up. Now, it seems like, well, that's November of next year, but the administration can't afford to have this trade war cause a recession in coming months because that will obviously hurt them in the midterm elections. And they've got a very thin majority in the House and the Senate.
Ed Yardeni with us. We continue with Ed Yardeni for a lengthy conversation in this hour. We welcome all of you in your commute. Good morning on Sirius XM, channel 121, Apple CarPlay, Android Auto. I'm saying the dashboards of the new cars, Paul.
Yeah.
You know, like the beast you have.
Sure.
It looks like a spaceship.
It is.
It's all, and you get your radio, you get 14 flavors, and thank you for picking your flavor to listen to us. Why don't you continue with that here?
Ed, given kind of what we know about maybe where trade tariffs and so on and policy may kind of flow here, it's going to be a little bit more restrictive. What does the Federal Reserve do here, Ed?
Nothing.
Okay.
That's been my view since the beginning of the year. None and done. When they lowered interest rates 100 basis points at the end of last year, I thought that made no sense. I think they were reacting to some numbers that suggested things were getting weaker, but I thought the economy was actually going to prove resilient. And I also thought that the bond yield would actually go up rather than down, and that's exactly what happened. Bond yield went up 100 basis points as they cut the Fed funds rate by 100 basis points. That's the risk they have now if they continue, if they resume easing. And so I endorse their current approach, which is to say that there are no rush to lower interest rates. I would actually prefer if they said that there are no rush to do anything, because by saying there are no rush to lower interest rates, they're indicating they think interest rates are restrictive when it's pretty clear we're in nirvana right now. Unemployment rate is 4.1%. Inflation is a little above 2%. Why mess with success?
Ed Yardeni, on the span of your study, I mean, I think of you and Ibbotson as equivalents at Yale in terms of the reach back to World War II and even back before that. The market treats the focus, the narrowness of growth is unusual. But is it unusual to have so few stocks giving us growthiness and our focus into those 20, 30, 40 stocks?
Well, it's really not unusual when you look at it on a global basis. In most stock markets, there are a handful of big cap stocks that really account for most of the market cap of those markets, and I think we're seeing the same story here. But look, I think that the reality is we've had a pretty broad bull market. It's just that the Magnificent Seven have done so extraordinarily well that everything looks kind of punky. But that's not the case. I mean, we've had, plenty of stocks up 20, 30%, but since we bottomed on October 2022. The Magnificent Seven obviously have outperformed them all and have accounted for a lot of the global outperformance. Now, they kind of stumbled at the beginning of this year on the whole DeepSeek controversy, whether that meant that these companies are spending too much on AI infrastructure. And they came back in the first quarter and their announcements and their earnings announcements and earnings calls and said, no, we're going to spend this kind of money because we think there really is a tremendous business to be had with AI. So they're moving forward.
Do you think the Mag 7 continue forward here as you see U.S. shares gaining overall market share away from Europe?
Yeah, I do. I have been recommending overweighting the U.S. since 2010, and it's worked out extremely well. But I could overstay my welcome here. Certainly, during the first quarter, it made more sense to overweight Europe than it made sense to overweight the United States. But I kind of view that as just a temporary situation. I think the U.S. will continue to outperform, though it's outperformed for so long that it's about 75% of the market cap of the global stock market. So, I mean, there is a limit to how much better it can get, I suppose. But it's been quite a run.
Ed, we're going to have earnings start next week. Our good friends at JPMorgan will kick things off in size here. Yeah. What do you expect to see from this earnings cycle? What do you expect to hear from companies as they talk about the coming quarters here? Because last quarter they were arguably and understandably reticent about forecasting the future.
Right. Well, first off the bat will be the big banks, and among them will be JPMorgan, and undoubtedly Jamie Dimon will be pessimistic as he tends to be.
Be nice.
And then report amazing results. And the stock will go up.
I got to stop the show. Ed, I looked at the Bloomberg FA screen yesterday for JPMorgan. They're making so much money.
Huge.
They don't want people to know how much money they're making. Am I off the mark on that?
I don't know. All I know is that Jamie Dimon and some other vocal billionaires keep telling us how bad things are.
Oh, listen.
And that kind of annoys me because, look
Michael
how rich they got.
Michael Barr, this is appalling. Ed Yardeni doesn't get an invite to the Bezos wedding in Venice.
Yep.
And he's going after billionaires. And to close it out, Torsten Slok, brilliant German economist over at Apollo Global Management, says the bond market and the stock market now are inconsistent. This is not consistent. Either the bond market is wrong and rates must move higher due to accelerating growth, or equity markets are wrong and stocks have to move lower because growth is slowing down. A wise one. Brief, Dr. Slok, which one is it?
I think everything is kind of the way it should be. We've got the bond market basically has normalized since the abnormality we had between the great financial crisis and the great virus crisis. I have no problems with the bond market being here at 4.5% plus minus 25 basis points. That's been our forecast since the beginning of the year, and lo and behold, we're still there. And I have no problems with the stock market making an all-time record high because of the resilience of the economy. So again, I think we have to pinch ourselves. We're in nirvana. The Fed funds rate is where it should be. The bond yields are where they should be, and the stock market's reflecting the optimism about what I call the roaring 2020s and the technological revolution we've been in since, let's say, the mid-1960s with IBM mainframes leading to this digital revolution.
For all of you across this nation and worldwide, Paul Sweeney and I are really committed to reviewing what the bulls got right during this time and this turbulence. Names like Belsky, names like Laidler, names like Yardeni that have been smart enough to stay on board. Paul, I'd include Liz Ann Saunders in there.
Yeah.
Not the young guy working for him. I mean, Kevin, suspect. But seriously, folks, this is really, really important. If you agree or disagree with Ed Yardeni, listen carefully. Can't say enough about Yardeni Research. Dr. Yardeni, thank you so much for joining us this morning.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So when Kelsey Berro walks in, you got to be prepared. I mean, Bob Michaels swanters in and we talk Greek and Latin. With Kelsey, we got to do the math. Paul watches the 2s-10 spread, the vanilla difference in yield between the 10-year and the 2-year. We've had curve steepening where the 2-year was a full percentage point higher than the 10-year. And we've steadily come up where right now the 10-year is half a percentage point higher than the 2-year. 2 standard deviations of this curve steepening is 65 basis points, or a little over 0.6%. What are the ramifications to our listeners and viewers if curve steepening gets out there where it breaks through 2 standard deviation steepness?
Yeah, so the curve has been steepening. It's been steepening from inverted levels. But when you look at the 2s-10s curve at 50 basis points versus history, that's still not a particularly steep yield curve. And I think that's because the Fed policy setting at 4 3/8 is still fairly restrictive. And so, we've had a modest move lower in the front end of the yield curve. We've had a modest move higher in front end, in longer yields. But that normalization, it's essentially getting us back to a normal kind of environment, which...
No, Paul, I just got a tweet, a message in here. Don from Washington emails in and says, how far out the yield curve does the Fed have influence?
Directly, they only have influence over the very short end. And so I think that is something that we've experienced even very recently with the Fed cutting rates at the end of 2024 and the 10-year yield actually moving higher in response to that as a function of, I think, what I would describe as those rate cuts were not necessarily cuts into a recession. Those were cuts into what I would describe as mid-cycle adjustment cuts. We've been moving the policy rate back towards neutral, and that's only further extended the cycle. So I think that, the listener, and thank you for the question. I mean, it's a very key observation.
No one else ever thanks me.
It's a very key observation that, there is no direct influence in the longer end of the curve. And let's step back and think about that structural shift that we've been seeing. There's a structural shift we've been seeing in the bond market away from the price insensitive holders, which were central banks, the public sector, to price sensitive holders being the dominant driver of the market. That's the retail investor, that's the asset manager. They are taking on a larger role in the fixed income market, particularly as holders in the treasury market. And as a result, you've seen demand for higher term premium here.
How much credit risk does JPMorgan Asset Management want to take these days?
So we're looking at companies and we're still seeing them in fairly good shape. So, and I don't want to take that for granted, but when we press our credit analysts across every single sector and we ask them, and we've been asking them, what happens if the tariff rate stays at 10? What happens actually if the tariff rate goes up to 20%? How will your companies handle this? And what we found when we model out those scenarios is that even under a fairly stressed scenario, and I'm talking about investment grade companies right now, in a fairly stressed scenario, investment grade earnings and revenues will decline, but will not turn negative under our assumptions, which just is an example of how strong the starting point is for companies these days. So yes, I do see a lot of challenges for the economy. We're in a sub-trend growth environment. I would say that with jobs data suggesting that the economy is very narrowly focused, it does suggest that there are risks, that we are more susceptible to those risks. But at the same time, companies have been preparing for challenging environments for multiple years now, and that's set them up to be in a fairly good position from a bondholder perspective.
I look at the INGO function on the Bloomberg terminal, the Bloomberg index browser. In fixed income in the U.S., U.S. corporate high yield has been by far the best performer. So it seems like the market is still rewarding, even below investment grade.
Yeah, absolutely. So I would describe this as a carry environment.
Okay.
And so if you look at the current index yield on the IN screen, right? So, so you pull it up and you look at the yield to worst right now on the U.S. high yield index at 7%. I would say
what is yield to worst again? I'm an equity guy.
That's a massive jargon alert.
Yes.
Yeah. All right. Just your yield. Yield to worst. Yield to maturity.
Yield to worst is afterthought didn't clean the dishwasher. What's yield to worst?
Regardless of which one of the yields you look at, one that adjusts for callable risk, one that doesn't. If you look at the yield, 7% is essentially where you're at.
Yep.
If we just stay here, right, spreads don't widen too much, they don't narrow too much from here, you have treasury yields around these levels, you should expect your returns over the next 12 months in a high yield index to look similar to the current yield. And that's essentially where we're tracking today when I look at returns. Now, there is one area where you've done actually even better, which is just to have an eye towards the global market, is some of these global fixed income indices have done even better.
Okay.
And that's been a function of the weaker U.S. dollar.
This is true. We got to get this in the next minute then. But then how does JPMorgan suggest you participate in international yield given a modeled weak dollar?
Yep.
I mean, is Kasman looking for a weak dollar?
We're looking for a weak dollar. We've been expecting a weak dollar. It's been a really good call of our currency team at a time where at the beginning of the year was actually quite out of consensus.
They all drive Ferraris as well. I mean, I get it.
And so, I think that what we do want to differentiate is the difference between sell America and a weak dollar. So you can have a world, and I think we are in a world where there is demand for fixed income assets in the US. We're seeing it in the strong end user demand for treasury auctions. We're seeing it in the strong demand for investment grade credit. But you can also have a weak dollar. And that is a function we've seen of foreign investors keeping their U.S. fixed income assets, but hedging them back to their local currencies.
Brilliantly explained. Yep. Can I ask one dumb question? I got 30 seconds. If Apple came out today with I'm just making the number up, folks, I'm an amateur, a $4 billion bond offering of tranches or whatever you call it, don't they just make one phone call to Fidelity or JPMorgan? I mean, the demand for that would be insatiable, right?
I think we've seen that. The demand is very strong. And typically, right, when you have periods of volatility like we've had so far this year,
people want.
Yes, but you also see supply step back, go to the sidelines. We haven't seen that. Supply has actually continued to chug along. People are out there issuing, and that's because, they see the demand on the other side.
Yeah.
Yes.
Paul, this is just the strangest market.
I know.
I mean, 5 firms could buy in all of Mag 7 debt. And literally, not exaggerating, one phone call.
That's right. Rob Schiffman has a job at BI.
At BI, Bloomberg Intelligence. Robert Schiffman publishing there. Yep. I have to look at that. Kelsey Berro, brilliant. That was really, really quite good. She is with JPMorgan. She put the flags on the new tower for 4th of July.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The governor of Connecticut joins us right now. Governor, it's so serious. I think I just really want to lean on this, which is the future of your Democratic Party. When you grew up and you grew up advantaged, there was a Republican Long Island, a Republican Connecticut and such. Do the Democrats have the gift to give up their majority because of a weakness of Democratic Party leadership? Could that happen?
No, I don't think so. I think there's some seasonality back and forth when it comes to politics. Obviously, Donald Trump had a big win, and he got his budget bill passed. I think within a year, you'll see the effects of that budget bill, and you'll see Democrats saying, this is really hammering working families and the middle class, and you'll see the political tides twist and turn.
New York City is turned upside down. I look in the Connecticut Mirror, CT Mirror conversation with you. You say that Mr. Mamdani ran a hell of a race. Folks is the arch progressive running for mayor of New York after a victory over Governor Cuomo and others. How should centrist Democrats respond to a generational change?
Look, I think that he did run a brilliant campaign, and we got a lot to learn from, especially guys my age. Look what he did in terms of social media. Young people hadn't voted for a long time. They don't often vote in primaries, and they often don't vote in the cities, and they sure as heck voted. So credit where credit's due. Look, he and I have very different styles, but at the end of the day, I've got a universal pre-K, a down payment there, prenatal education, doing everything we can to make it easier for people to get ahead in life and make life a little more affordable. So there we have a lot in common, but we have different styles.
Governor, President Trump obviously has a great skill at just, commanding the narrative here and just kind of taking in terms of other folks, maybe taking a lot of the oxygen out of the room. What do the Democrats need to do from a messaging standpoint heading into the midterm elections?
Look, he's got a very loud voice. sort of herky-jerky every day. It changes, but he dominates the landscape. Very tough for, me as a governor when you just don't know what the budget's going to be one day to the next, what the tariffs are going to be. It's tough to invest and make long-term commitments there. I think the Democrats have just got to be clear as day. We're fighting for the middle class. We believe in bottom up. We believe in this state of Connecticut. We've had more new small business startups than ever before. And those are a lot of small businesses starting up on O'Whaley Avenue in New Haven. And I think that's how you grow wealth. And I think that's how you get our cities back to life. And I think that's how you fight for working families in the middle class.
Governor, it seems like for both parties, perhaps, the extreme right, the extreme left seems to be driving the politics for each of those parties. Is there even a center left for either party or both parties?
It's getting smaller because I'm there, and you're right. I think after Donald Trump's election, the Republicans are a lot less likely to want to talk to me. I always had a big table and an open door, and a lot of people looked at me and said, "God, it looks a little like a Republican." And the Democrats are sort of really fighting Trump every day, and if you don't go after him on a daily basis, you're sort of being weak in terms of your principles. So you're right, the middle is getting very small, and that's not a good thing for America.
Ned Lamont with us from Connecticut. We continue. We welcome all of you across the nation, and certainly in the Bloomberg 1130 area here, an interesting conversation of Republicans and Democrats in the summer of 2025. Governor Lamont, Bloomberg wrote this up on Paul Tudor Jones, noted hedge fund dude, exiting to Palm Beach, Florida. There's a fear in the tri-state area, and frankly, there's a fear in Boston and Washington that with adverse policy, that migration will continue. How have you tried to respond to fancy people in Greenwich as they climb on their Hinckley picnic boat and head south? How have you responded to that threat?
Tom, I think twofold. One, we were raising taxes on a every other year basis going back 10 years in this state. That hasn't happened on my watch. We haven't raised tax rates. I think that gives people some comfort that we're getting our fiscal house in order and we're not going to balance the budget by raising taxes. And I also tell people, look, this is the state, the town where you grew up. This is where your children or your grandchildren are. You can watch them, on Zoom from Palm Beach, and you can be right here with them every day. And it's something to be said for making sure this is a place where you can stay in the community where you grew up and where your family is.
So, Governor, what do you think the future is of this Democratic Party here? How does the Democratic Party regain some momentum, any momentum here? Because it just feels like it has absolutely zero momentum at this point.
I think you're already seeing it happen. I think, the Trump, budget is going to really impact middle-class families. You're going to see what it means in terms of folks getting thrown off of health care. You're going to see what it means in terms of folks not getting their food benefits. We have $50 million of cuts. Just the portal turned off 3 days ago for after-school programs. I think this is going to impact middle-class families. So right now it's all peaches and cream and tax cuts, but wait till you see how this impacts your everyday life.
Governor, one final question. We have to go back to our discussion of a few days ago, heated debate within Bloomberg surveillance and a huge nationwide response. Governor Lamont is a traditionalist of old money in America. Do you go for the cold Maine lobster roll, or are you loyal to the warm Connecticut lobster roll?
You mentioned the word Connecticut. That makes it easy for me. But the lobsters are fleeing Maine too. They're going north to Canada. So you got to watch out. The tides are turning.
We'll need a new policy.
I really worry. Go ahead.
Well, we'll need a new policy on that. Governor Lamont, we're out of time. Thank you so much for joining us. I believe that was a voice for the warm roll that you and I.
Yeah, sure. I mean, either way, they're both good.
Exactly. You take both, one of each. Governor Lamont, thank you so much. Connecticut there and the future of his Democratic Party.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.
Brad Case joins us now. We always have a huge response when he's on, studying under Robert Shiller at Yale. Dr. Case is with Middleburg Communities. They do residential and multifamily real estate in Virginia, really into the pulse of the market. Within the zeitgeist, Brad Case, what do we get most wrong about America's housing market?
Well, I think that there are a lot of ways in which we could work to increase the supply of housing, both owner-occupied housing and rental housing. And we see the importance of that with how expensive houses have become. It's really, really very difficult for somebody to purchase a house nowadays, and especially when they're concerned that the prices of housing may go down in the future. So there's a lot that governments at all levels can do to make it easier to build housing. What we're seeing is that there's a tremendous increase in demand for housing, and we're just not seeing an increase in the supply of housing. In fact, it's been going down.
So what's your prescription for New York City as one example?
Well, New York City is a very special case. We focus, in fact, not just in Virginia, but the entire Mid-Atlantic and southeastern part of the country, because there's such growth in population and employment in that part of the country. And that's not a story that's really going to be told about New York City or some of the other older, very, very pleasant cities in the Northeast and the West. They're just not growth centers. So the prescription for a place like New York is entirely different from the prescription for a place that people are trying to move to.
Brad, why is there a supply shortage? I mean, with the nail gun, if nothing else, houses go up in 15 minutes these days. Why aren't there more houses out there? Why isn't there more housing out there?
Well, it has to do with providing the permission to build housing and the infrastructure. And so what we've seen is that there are lots of places where the people who currently own houses don't want to see any more housing, because if there's a lack of housing around them, that drives up the price of their own house. So the problem is that you've got a lot of people who need housing, who are younger, who want to rent a place, want to buy a place, but they're being shut out of the market by other people whose goal is to increase the value of their asset. So there's a lot of opposition to construction of new housing everywhere in the country.
Boy, I don't know. It just seems like I just see these residential communities going up all over the place, and yet I still, 4, 5, 6 years in, we still hear about housing shortages here. How did we get here, Brad, in terms of this housing shortage? This wasn't a thing, I don't know, 5, 6, 7, 8 years ago. I just don't remember ever hearing about it.
Well, no, I think it's actually something that's been going on for 50 years. We back into the early 1970s, we were building quite a bit of housing, and there was a tremendous increase in the number of households looking for housing, especially after World War II. What people don't realize is that over the last 10 years, we've had an even bigger increase in the demand for housing. But we haven't gone back to those days in the 60s and 70s when lots of housing was just being built.
Have we not gone back to the 60s and 70s because the land is not available? Clearly, in the greater tri-state area, that's true. I'd suggest maybe up in Boston as well. Is it a land issue? Is it foundationally about land?
It's not really about land. It is, in a place like New York or Boston, there's a very strong public transportation system that makes suburban areas available to people. So you can put housing there and people can still get the jobs. In lots of places, they haven't yet built the same level of transportation infrastructure, which makes it harder to move out farther into to where the land is available. For
your commute across the nation this morning, the chief economist saw history at Fannie Mae and with Shiller at Yale University. Brad Case is with us at Middleburg Communities. Brad, every weekend there's an article, OMG, the South's going to die. Housing prices are down, rents are down. Do you buy it? Is there a permanence to that debacle?
Oh, not at all. In fact, what we saw was a tremendous increase in demand for housing in the Southeast and in Mid-Atlantic especially because of the COVID shutdown. But what that did was it stimulated a big supply response. And so we had a supply surge a few years ago. But that supply surge has really entirely ended. The new construction of housing, especially in our part of the country, has come to a crashing halt. And so we very recently, very quickly moved into an undersupply housing shortage situation, even in the part of the country where housing is easiest to develop.
So, Brad, I'm looking at the 30-year fixed mortgage from the Mortgage Bankers Association, 6.79%. I got to feel like that's kind of got to be the new normal. If so, when do buyers and sellers kind of accept that as a new normal? It doesn't seem like that's the case yet.
Well, there's no real pressure for sellers to accept the lower prices that they would realistically be able to get. And the problem for buyers is that they don't want to buy into a situation where they will be the ones accepting the lower prices. I think you're right. I don't think there's any reason to think that mortgage interest rates will go down anytime soon. Even if shorter-term interest rates go down, the Federal Reserve has indicated that it wants to reduce what they used to, what they called the quantitative easing, and that will increase mortgage rates.
So in so many parts of the country, Brad Case, is renting better than buying?
Well, that is usually the case, and the reason is that people don't realize when they buy a house, they have to give up a huge chunk of money, the down payment. And if instead they put that money into productive investments, especially in the stock market, then in the long run, they would probably build more wealth. So there is this myth that the way to build wealth is to buy a house. And the reality is that usually that's not the case. If you're able to buy a house when houses are cheap and the stock market is overvalued, then great, take your money out of the stock market and buy a house. That's not our situation right now. Right now, houses are very expensive, and if houses crash, then you'll probably see the stock market crash at the same time. So generally speaking, to build wealth, you're better off renting. Now, there are other reasons to buy, and some people want to buy just so they can say they're homeowners. That's not the same as building wealth.
Brad Case, thank you so much. I just really can't say enough about it. Got to get John more.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lisa Mateo, live and in color, digitally perfect on YouTube. What do you got today, Lisa?
All right. Do either of you pay for TSA pre-check?
Yes.
You do pay for it?
And clear.
Okay. And clear. So
I
you
do
both.
clear,
Yes.
which
I'm clear.
I'm mixed. Okay,
Yeah,
clear.
mixed, sometimes good, sometimes.
The reason for the TSA pre-check, the big draw
Yes.
to it is what? The shoes,
No
right?
shoe-
You can
yep,
leave
exactly.
the shoes on if you have the TSA pre-check. Well, pretty soon everybody could be getting
Finally.
that perk, not just the ones who pay for it. Sources are saying the TSA is really considering to make these policy changes. They want to kind of speed up the security screening
kidding.
times as you go through. It's been around for nearly 2 decades. I mean,
I
you
know,
think about
I
it,
know.
August
9/11.
2006. Yeah, 2000. Remember the shoe bomber? You know, that failed attempt. So that's kind of what sparked it. Critics are saying, you know what, it does nothing for security. It's this whole theatrical thing. So the TSA has not made it official. These are just, sources saying, but other airports, I mean, you think about, across the European Union, Dubai, Singapore, they all allow you to keep your shoes on.
Yep. Yeah,
So
it's
they're
silly.
kind
I
of
think
having
it's
come up to date.
silly.
I understand how it kind of came about, but
Sure,
it's
sure.
come on,
It's
with
so
all the technology today.
uneven.
Yeah.
You're sitting in Zurich and they're like laughing at us.
Yeah.
I mean, there's no other way to put it.
I know it is a
I
little,
don't
and
know.
then for the women, you have your shoes, and you got to carry the socks in your bag because you don't want to wear barefoot on the floor. I mean, it can be a little bit stressful. Okay.
Yeah. Good point. That's a good one.
It can.
Good change.
Okay. I have this next
Was that
one.
girl talk that we just had?
It
Yes.
was. If you're wearing the fancy shoes,
Of course,
you don't
which
wanna
you
walk
always do.
barefoot
I
on
mean,
the
you're.
floor.
That's what they always
Get
does.
the Roger Vivier shoes going.
Yeah.
I know. Okay. Next story. I've been kind of toying with the idea of getting a tattoo. That's a story
Whoa.
for another day.
Whoa! There's too much information.
I I saw this article.
Control room just woke up.
The Wall Street Journal. It says that there is an AI-driven tattoo robot that is taking appointments. Okay? It is an Austin, Texas-based startup. It's called Black Dot. Okay? They raised about $7 million for this company.
Wow.
But here in New York City, they are installing their first one. It's taking appointments now. It's at this place called Bang Bang in New York City. So the way it works, just to give you a brief rundown, the human operator, it starts it, okay? But then the arms scan the skin. They have this like extended triple pointed needle. The thing about it is that it's supposed to be less, it hurts less because it doesn't go as deep into the skin.
Pray tell, what tattoo would Miss Mateo select?
I'm thinking about it, and maybe a little risk thing. I don't know. It could be a mother-daughter kind of, bonding moment. I know, Mother of the Year.
But what if you break up with your daughter?
And I can neither confirm nor deny that I have a tattoo.
Ooh,
so we'll just leave it at that.
Oh, Sweeney coming through.
All right.
But it's but the thing is, there's concerns from tattoo artists who are like, wait a minute, this is my job. What are these robots coming in? So there's that side of the story too.
All right.
Okay, I want to end with this one. This is in the Washington Post. This is a great story. The 67-year-old historic U Street diner, synonymous, right? Washington's cultural political landscape. We're talking about Ben's Chili Bowl. Started with the Ali family back in 1958, still family owned, operated. But the thing is, it's going to be shut down for a while. They're in need of these big renovations, HVAC, the roof, the electric panels, plumbing, and they're going to be shut down for several months. It's the longest stretch ever for this restaurant before. So they're hoping that when the updates are done, that it doesn't change the interior feel of it that people are used to. We kind of touched upon this with I think it was a Cracker Barrel, how they wanted to keep that, same kind of inside feel that people are used to. But they're hoping that it doesn't change this for the restaurant.
It is magical. Have they shut down yet? I don't think so.
You've been, no, July 14th.
Anybody in Washington who's never been, U Street, Northwest, you got to go. It is absolutely magical. Lisa Mateo, on the way to the tattoo parlor this afternoon, thank you so much. Greatly appreciate that. It's our newspapers with Lisa Mateo.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.